Forbes released an article today running through the 5 top dividend stocks, which they believe every single one of these is a bargain right now. We're going to run through each one, give you our thoughts as well as our buy prices. First one, very interesting to see. It is a strong buy rating from both Seeking Alpha and Wall Street with a hold from Quant, which seems to be very typical. It is Essential Utilities, ticker symbol WTRG. Now, we do note it is trading in the mid to upper end of the 52-week range. It has a nice forward yield, just above 3%, and a forward P that sits just above 20. S&P right now around 23, but as always, we'll look at the relevant sector PE to give you an understanding. In terms of the last 12 months, well, it is down around 2%. Over the last 10 years, if you have been a shareholder, you would be up around 59%. We can see all-time highs does sit around the back end of 2021 at around $54. Now, when we take a look, nice to note it has a very safe dividend score of 93, and they did also increase their dividend last August, nice high single digit, meaning we are anticipating an increase over the next month. Now, in terms of dividend safety, as we just run through, given this was just reaffirmed, it does mean a dividend cut is highly unlikely. Now, in terms of some very key metrics, especially for those that do see a recession inbound, like what we saw in the Great Recession 07-09, what we can see is, in fact, they increased the dividend during that period. They had plus 1% recession sales, a lot better than the average of the S&P at negative 12, and they significantly outperformed negative 19 with the S&P during that period, negative 55. On top of that, we love to see this consistency in that dividend increase, 7% over the last and 5 years, as well as 8% over the last 20 years, well above that minimum 4% that we say to achieve just to keep up in line with inflation. They are also a dividend aristocrat. They have increased those dividends for more than 25 years, 32 to be exact. In terms of dividend yield theory, now for those that are new, states a company is undervalued when the current yield sits above the 5-year average. We actually have a double sign of undervaluation, both on the yield as well as the forward P at 20, sitting below the 5-year average of 26.5. Just bear in mind though, it is higher than the utilities of 16.6. But as always, we never look at any of these models in isolation. Now, what we quite like to do is look at the earnings payout. Typically, we do look at the free cash flow. For utilities though, it is a lot more volatile. Below 75% to be industry specific for water utilities. Even though it has been increasing over the last 10 years, we can still see well below 75%, and 2024 at 63% still does look very healthy. Earnings per share as well, nice to note it has been increasing over longer term, something that we do want to see, as well as that consistency on a year-on-year basis, and that is expected to continue over the next 12 months as well. When we draw your attention to the sales growth, do bear in mind with these type of companies that are in the utilities industry, they are fairly cyclical. So we do see some very strong years, some very negative years, as well as some years that are pretty much flat. We want to point out that over the last year, it is down around 10%. But on another note, in terms of the earnings per share growth, it is fairly consistent around the low to mid digits as well. But we can see over the next 12 months, it is anticipated to drop by around 7%. In terms of total sales though, we do know that it has more than doubled over the last 10 years, but you can see some very large periods where it has stayed stagnant and then years where it has really accelerated. Again, just the nature of cyclical industries. Bear in mind, with shares outstanding, we always want to see companies do share buybacks. With essentially utilities, they will dilute your position over the longer term, as unfortunately they do, as we can see, issue equity to fund a portion of those growth expenditures. We then move on to the ROIC, return on invested capital, a very important metric. The ideal scenario is to see above 7.5% across the board. What we do know, that has been decreasing year on year. We do get to see 5% over the last few years. Main reason we want to see a strong metric, this does give us faith management are able to effectively allocate their capital. We get to see the free cash flow margin above 18% for water utilities. It has been above that, but again, fairly inconsistent over the longer term. Point here to make though is that it is consistently above that, even in the poor performances within the cycle. Then when we look at the net debt to EBITDA, very, very important. This is the earnings before the interest, tax, depreciation, amortization. Below 5.5 is what we want to see for this industry, and those numbers that you can see effectively show us the number of years it would take the company to pay off all of their debt net of cash on hand. Now 6.8 for 2023, and in fact over the last few years it has been above the maximum we want to see. Something to bear in mind, Positive to note here, however, is over the next 12 months, it is expected to reduce drastically, still above 5.5, but it is moving in the right direction, and we did also get that very safe dividend score. Now, the intrinsic value in today's episode is just below $46. As always, today's episode, we're going to run straight into it, but if you are a regular, you know for our deep dives, we do go into each model, the inputs and the outputs. Now, with the current price just below $40, we always use an MOS. 10% is what we start off with, and we execute on that if it meets the 3 criteria: the wide moat, the strong financial metric, and the good forward-looking data. Now, if you believe that in today's episode for this company, it is a buy up to around $41.37. At 15%, we can clearly see it is only a few cents shy, so you could argue 15% margin of safety, and Wall Street, as a matter of fact, give this 16% upside, $46 price target. Now, there will be some people who will like this company but want a larger MOS. At that 20%, you would have to wait for around $37, but as always, do let us know your thoughts as we do go along. Now, before we move to the next stock from Forbes, just to let you know, today we release our latest free weekly article. We give a market update as well as 5 cheap dividend aristocrats you need to consider in the portfolio. As always, if you want access to this or any other articles, all completely free, click on the pinned comment below and you can start reading straight away. The next stock is the Hershey companies. Now, this is trading in the lower end of the 52-week range. We get a double buy rating. Now, Wall Street in this case are the ones with the hold. The forward yield sits at 2.9% and the forward P, as we can see, just below 20. Over the last 12 months, well, down 21%. Major reason being the increase in prices in cocoa that we did see not too long ago. Over the last 10 years, though, whilst they are up 101%, they are quite some way away from all-time highs, sitting around $275. In terms of dividend safety, well, they do get an 80 score, and we do quite like with this company, they have typically increased the dividend at a very nice rate, 15% in the more recent February 2024. You can also see that the safe score does suggest a dividend cut is unlikely, and in the last recession, well, they actually maintained the dividend, didn't increase it, didn't cut it. They had above average growth, negative 0.1%, and we can also see they did outperform the S&P with their negative 30% return. As we said, very nice increases to the dividend, double digit this year, double digit over the last 5, as well as double digit increase over the last 20. Not only have they been increasing the dividend for the last 14 years, but they have been paying a dividend for the last 94 without a reduction. Now, in terms of dividend yield theory, again, another double undervaluation signal, a very severe signal on the yield, one of the highest it has offered over the last 5 years. We do also note the forward P, 19.8, is significantly lower than the 5-year average, but we do want to point out that consumer staples is marginally lower as a sector at 18.5. In terms of the free cash flow payout, well, below 70% now for consumer staples, pretty much below that year on year. We do also see over the next 12 months anticipated to come down to 53%. And when we take a look at the free cash flow, whilst you may not see consistency, you do see over the longer term it has more than tripled the free cash flow. And again, over the next 12 months, it is expected to increase by a very large margin. In terms of sales growth, well, typically 3 to 7%, and we can see again a little bit inconsistent. Nice to note over the last few years, it has been very strong, and we can see over the longer term, they have increased their top line by around 50%. Now, yes, we do like it when companies do share buybacks, but with Hershey, whilst they have done that, it does look to be fairly trivial and also pretty inconsistent. In terms of ROIC, though, it does look very good, very consistent as well. In fact, just over the last 6 years, it has been sitting around the mid 20%. Again, this is a very attractive metric for investors when they do get to see that consistency and a very large number. We also quite like the operating efficiency, not only above the minimums on the margins, but over the longer term, it has been increasing. And free cash flow margins, no issues whatsoever there, above the 7%, in fact, well above, especially over the last few years, 14% in the more recent year. In terms of the net debt to EBITDA, well, now we bring it down to below 4 for consumer staples, 1.49 in 23, 1.67 over the next 12 months. No worries whatsoever, as well when you combine that with the factor that their free cash flow payout does look very good as well. Now, in terms of the valuation, we do get to $208. Remember, you can grab a copy of this model by clicking on the pinned comment below and putting in your own numbers. Margin of safety then at Hershey for 10%. It is a buy, pretty much at this price now. So if you do see this as a high quality dividend growth company to add, you are getting a 10% margin of safety. For those looking at 15%, you would have to wait for around $177, and we can see Wall Street, who did consider this a hold right now, seeing around 11% upside over the next year with a $208 price target. We then move on to NextEra Energy, where we actually get a double buy rating with a hold from Quant, trading towards the mid to upper end of the 52-week range, 2.71% on a forward yield, and in terms of the P right now, around 22.3. Over the last 12 months, while it is down 3%, over the last 10 years though, you would have outperformed the S&P. They are up around 189%. Bear in mind this doesn't include dividends reinvested, so you would be up marginally higher, although we have seen all-time highs quite a number of years ago now, back end of 2021, $93. Nice to see the very safe dividend score of 90, as well as the double-digit increase to their dividend just this year, and again it was reaffirmed, so dividend cut is highly unlikely. They also increased their dividend during the last recession, average growth, as well as significantly outperforming the S&P 500. Again, very strong, just like Hershey. They are very consistent in increasing those dividends over the last 20 years by double digits, and we can in fact see they're also a dividend aristocrat, more than 25 years of consecutive increases. Now, when we look at dividend yield theory, again, another double undervaluation signal, both on the yield as well as the forward P, but we do note it is considerably higher than the utilities as a sector as well. Remember, utilities, we're not looking at the free cash flow payout, not only below 75% year on year, but pretty consistent around the high 50s, low 60s, so no worries whatsoever. And when we do look at the earnings per share, similar to the first utility, or in fact the water utility we looked at today, consistent increases over the longer term and anticipated to continue over the next 12 months. In terms of sales growth, well, again, remember cyclicality. In fact, 4 of the last 10 years have been negative. And what we do quite like is that the earnings per share are pretty strong. Just over the last few years, we're looking at double digits as well as high single digit in 2023. Then when we move on to the numericals, we can again see it has increased, but again, just remember whether or not it's in the utilities, there are some sectors that are very cyclical, so don't expect all companies to have their revenues go up consistently year on year. And also, as we mentioned, they do essentially dilute your position, as we can clearly see here over the last 10 years. The inconsistency, the cyclicality as well does show through a lot of the metrics, as we can see with the ROIC. Nice to note though that 7% over the last full year. And when we do talk about the operating margin, again, whilst we do know that it is going to be cyclical and inconsistent, it is still above the minimums that we want to see. 36% in 2023, looking very strong as well. Finally, the net debt to EBITDA, something you should really look at for utility companies. 4.43, which is very good. It is below that 5.5. Expected to be there or thereabouts over the next 12 months again. So we can clearly see why this company does have that very safe dividend score, as well as the nice consistent double-digit increases to the dividend. Intrinsic value then at just under $79 with an MOS level at 10%. We pretty much see again, if you do believe this is a high quality company over the longer term, then right now you are getting a 10% MOS, with Wall Street indicating 13% upside and an $80 price target. Again, for those that are looking at maybe a 15% level, a buy at around $67, and at 20% you would be looking at around $63. As always, do let us know your thoughts as we go along these today. We then move on to one that we actually covered not too long ago. However, it did make Forbes list, so we did want to bring it back. It is Darden Restaurants, with a buy from Wall Street and a double hold from the other analysts, trading in the mid to lower end of the 52-week range. Forward yield just below 4% and a forward P just below 15. Now, over the last 12 months, down 14%. Over the last 10 years, however, you would have significantly outperformed the S&P 500. And when we do take a look, nice safe score of 70, and again a nice increase, in fact, just last month of 6.9%. Again, reaffirmed that the dividend cut is unlikely, and we can see they increased the dividend during the last recession above average growth, and also marginally outperformed the S&P 500. As always, something we love to see, either high single digit or double digit, and that is exactly what we get to see with DRI. However, when we do take a look, we can see they did have a dividend cut during the pandemic, and therefore they only have 3 years of consecutive increases. In terms of dividend yield theory, well, we do get that undervaluation signal both on the yield as well as the forward P, and when we do compare it to the consumer discretionary, it does sit lower at 13.7. In terms of the free cash flow payout, now for restaurants below 50%, it has straddled pretty much slightly above that year on year, but for me personally, 60% is my blanket rule, and the fact that it's been around that over the last few years and expected over the next 12, that does give me comfort that it should be okay so far based on this information. When we move on to the free cash flow, very nice. Yes, you are going to get inconsistencies with the economy over the longer term, and that is what we get. But what we more importantly get to see is that over the longer term, when you do zoom out, it is moving in the right direction, and again expected to continue over the next 12 months. When we look at the sales growth, again, pretty much similar. It does look very strong, but there are some years where they do suffer, like the pandemic. Again, no surprises whatsoever. But we can see just over the last 2 years, very high single digit, well above that minimum 3 to 4% for inflation. And we can see over the last 10 years, nearly doubled. In terms of shares outstanding, like we've already discussed in some companies today, whilst they have bought shares back, in fact, they also issued shares in 2020. Over the longer term, it is very marginal and very trivial to discuss. But when we look at the ROIC, we do get that consistency if you do remove that COVID years, and we can see 14% over the last 3, in my opinion, is fairly strong. Then when we look at the margins, something that when you do take a look at the restaurant industry, it is somewhere where a lot of them could really use some efficiencies on and improvements. What we do know, however, over the longer term, they have brought it from 6% in 2015 to 12% in 2024. Finally, this takes us to the net debt to EBITDA, below 3.5 for restaurants, 3.59 in 2024, expected to go lower over the next 12 months. So it's a very good sign that they are reducing that debt balance as well. Does make the company a lot healthier if they can execute on that. In terms of the intrinsic value, well, $187, margin of safety on a current price of 144 gives essentially a 168 buy price if you are happy with a 10% MOS. For those at 15% at 159, and as always, we keep going till it's near the current trading price. Not at a 25% MOS level just yet, but right now you are getting at least a 20% up to $150, with Wall Street considering 22% upside, their 176 price target. So it does definitely look like one for consideration, especially if you are looking for a restaurant company to add to the portfolio. You could argue we have left the best till last, Coca-Cola Euro Pacific Partners, with a double buy rating from Wall Street and Quant. In fact, Wall Street isn't too far away from being a strong buy. That would have to be at 4.5. We do see it in the upper end of the 52-week range, with a yield on a trailing 12-month basis at 2.79, forward P of 17.22. Now, over the last 12 months, they are up around 14%. Over the last 10 years, however, they are up only around 50%. Bear in mind, this will always depend at which point you did buy. For example, if you did buy it when it was all the way down at around $31, then again, you would have made a lot of money. This does essentially mean that the 50% is if you'd bought from 10 years ago today. So again, just bear that in mind. When we take a look, now we don't have a dividend safety score currently, but we can see their last increase to their dividend was 10%, something we always love to see on this channel. And in fact, when you do zoom out, 12% over the last 5 years, 9% over the last 10. In terms of taking a look then at the metrics, what we do know on the free cash flow payout, well below the 60% blanket rule we have, 41 in 23, 41 over the next 12 months. So no surprises with these companies that they are able to pay such a strong dividend. When we take a look at the free cash flow, well, we can see pretty much doubled over the last 10 years. However, we do want to point out it is anticipated to drop over the next 12. In terms of the sales growth, well, we get 2 years of negative growth. You could argue 2020, the pandemic, but we do also note back in 2014. Since then, though, 30% in 21, 26 in 2022, and even though it has dropped in 2023, still above the minimums that we do want to target. In terms of looking at numerically, well, they've tripled it over the longer term. That is their total sales going from 6 to 18 billion. But unfortunately, we do have to point out they would have diluted your position if you did buy this company 10 years ago. However, if you did buy in 2017, then they would have had some share buybacks as the net position. Again, as always, it will depend at which point you were a shareholder. We then move on to the ROIC. Very nice to note, 10% in 2023, but prior to that, we do get a lot of inconsistencies. Again, something you can always factor into your margin of safety. When we take a look at the operating margin, minimum 16%, they don't get there quite yet, but what we do know is they have been very consistent every single year over the last 10 years. Free cash flow margin above that minimum 5 we want to see, and again, consistency is something that a lot of people will pay a bit of a premium for. In terms of the net debt to EBITDA, well, the blanket rule is typically below 3.5, which we do get in 2023. Again, if they can execute on this over the next 12 months, that is a very good sign that the balance sheet is strengthening quite substantially. Now, the first thing we want to point out is that Wall Street do see some very nice upside at 43%. Their price target $105. And actually, when we did our analysis, we believe the intrinsic value is a lot higher. As always, though, let us know if you do want us to do a deeper dive where we can take a real look at this company. Current price then just above $73. Margin of safety will be quite significant at 10% a buy at $106, at 20% around $94. 30% around $82.50, and we can see in today's episode you're not getting a 40% MOS just yet, you are getting at least a 35%, and remember, Wall Street do like this significantly, upside of 43%. As always, don't forget you can grab copies of these models by clicking on the pinned comment below and running your own numbers, but let us know your thoughts overall with these 5 companies that Forbes do believe to be very cheap. Are you looking to add any, maybe on the watch list, or maybe for whatever reason they're not for you? Don't forget, if you enjoyed this episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.